All right, to quote Benjamin Franklin, there's 2 certainties in life, death and taxes. Today we're going to talk about the latter and 6 strategies you can implement to make tax season a little bit less burdensome. All right, so to help demystify the tax season, I have my little man Jude, 4-year-old here with me to help talk taxes with you today. So we're going to talk about 6 strategies you can utilize in virtually any phase of your life to take the most advantage of tax credits and different tax strategies to lower your tax bill. So the first thing that we're going to talk about today is maybe one of the most obvious strategies out there. What is it?
Retirement plan.
There you go, retirement plan contributions. So this is one of those things that we see too many clients not taking advantage of in their situation. So a good example of what we're describing here is, let's say you have a 401k at work and you have the ability to put $20,500 a year into that plan. That's going to reduce your taxable income dollar for the amount that you put in. So that's $20,500 that's not going to be taxable income in this given year. And then something else that's really fantastic is if you're over the age of 50, you can put additional $6,500 into that retirement plan. So every dollar you put in is a dollar of earned income that's not going to be taxed in this year. Take advantage of that. It's a wonderful tool. The second thing we're going to talk about today is HSAs. Little man knows what he's talking about here. So this is one of the most underutilized strategies out there, but a lot of folks, not even realizing it, have access to an HSA plan, a health savings account with their employer. So there's, first and foremost, the reason this is such a fantastic thing is it's considered triple tax deferred. So any dollar you put into a health savings account, it will never be taxed if you take it out to use for health insurance, either premiums or qualifying health expenses. And you can, if you are a family, you can put up to $7,200 a year, that should be for 2022, into this plan. And the unique thing about it as well is you don't have to use those dollars. So if you don't use your HSA dollars, they can build up over time in the plan. And when you near retirement, you could have a potentially tax-free bucket of money to utilize for your medical premiums or different qualifying health expenses. So again, it's a very underutilized thing, but something fantastic nonetheless. There is one thing to think about is you have to have a qualifying health plan to utilize one of these. And usually those are high deductible plans. So you need to think about your cash flow. Talk to an advisor if you want to know if you qualify for one. We're all very familiar with them around here at 10 Capital. Number 3 that we're going to talk about is what, Jude? Mortgage interest deduction. Good job, buddy. So mortgage interest deduction. So this used to be the number one thing that any homeowner used to use when you itemized your deductions. So since the 2017 Tax Cuts and Job Acts legislation that went through, it effectively moved everybody from anybody that was, not anybody, but most people in the US that were actually, even a homeowner that were taking itemized deductions, it makes more sense now to actually take the standard deduction. So this is much less of a utilized deduction at this point, since so many people don't itemize. However, it's one thing to keep in mind is if you have a year that you put a lot of money into charitable contributions, you own a home and maybe you refinance a home, because when you refinance, a lot of times that'll increase your deduction that you can take in that year. If you add all those things up, it's still something to calculate and understand. Does it make sense to take the standard deduction, or maybe in that specific year, itemizing may make more sense. So talk to your tax pro about it, or if you do it yourselfer with taxes, run the analysis on TurboTax or whatever software you're using, because it is sometimes something to look at that people are not quite aware of. There you go. So number 4 that we're going to talk about is what, Jude? That's a tough one. Charitable donations. So again, this is one that a lot of folks aren't utilizing right now because so many households have shifted from itemized deductions to the standard deduction. However, there's one technique that we use with a ton of clients. It's called the Qualified Charitable Distribution Strategy. So when you have a retirement account and you turn RMD age, required minimum distribution age, that's currently age 72, you have to, per IRS guidelines, you have to take some money out every calendar year because taxman doesn't want to wait for you to pass on to tax those dollars. So during your lifetime at age 72, you have to start taking money out of your retirement plans. What the qualified charitable distribution strategy is, and we have a ton of clients using it here, is if you're going to donate to charity, if you do it straight from out of your IRA or 401k and you send it directly over to a qualifying charity, a 501c3, those dollars will never be taxed, whatever amount that is. So you need to make sure you're taking this strategy on in the correct manner, that you're filling out the correct form. So talk to your advisor, whether you're here at 10 or somewhere else. This is a wonderful strategy to minimize taxes, especially when the IRS is mandating you take money out of those retirement plans. So number 5 that we're going to talk about today is what, Jude?
College costs.
College costs. So interest on your college loans, or if you are paying for qualifying educational costs, so if you have a kid in college that is a dependent, these are things that are deductions that you can take, and they're actually considered above the line deductions. So you don't necessarily have to itemize your taxes to still take advantage of these. So even if you're taking the standard deduction, you potentially still could take interest from your college loans and or qualifying tuition expenses. You could still deduct those. There is an earned income limit on this, so if you're making too much money, it doesn't matter. You don't get to take those as deductions, but it's something to really think about with regards to are you utilizing that deduction or not. All right, so the last one, number 6, the last one we're going to talk about is what, Jude?
Roth Conversion.
Roth Conversion.
Roth Conversion.
Don't whisper. Can you say it louder?
Roth Conversion.
Roth conversions. He knows what he's talking about. So this is a fantastic one. We utilize this with a lot of retirees. A lot of folks think that a Roth conversion strategy is a pre-retirement strategy. Many times what we see when folks are nearing or actually in retirement before they take Social Security, utilizing a Roth conversion strategy to minimize your future required minimum distributions, i.e. your future tax bills. It makes sense, and that's something that I screen out with every single plan that I do personally. I know most advisors around here are doing the exact same thing. And just so everybody knows, a Roth conversion is you're taking pre-tax money that may be in your IRA, you're taking money out, you're paying taxes on it, and immediately putting it into a Roth IRA each year. So it creates a taxable event in the year you do it. But it allows you to have a bucket of tax-free money that you can use later on in retirement, and or it's a very tax-efficient wealth transfer strategy. So today, those are the 6 big things we wanted to bring to light. My little guy Jude knows what he's talking about. Can you say thank you, Jude?
Thank you.
He says thank you. Appreciate you guys. We'll talk to you soon. Hope that helps. Jude, can you say retirement plan?
Retirement plan.
There we go. Can you hear that?
It sounds perfect.
Can you say it a little bit louder?
Retirement plan.
There you go. All right.